What's up, everyone? It's Scotty with MoneyVest. So markets here with a huge reversal on the day. They actually did rally after the statement from the Federal Reserve with unchanged interest rates, so keeping them where they are at 5.25% and 5.5%. And Jerome Powell, of course, stressing the idea that they're not getting greater confidence, they're not gaining that greater confidence that they were looking forward to in 2024 because of higher inflation, and of course inflation being a little bit more stickier than what they anticipated in the past. However, also ruling out the possibility of a rate hike, suggesting that it's unlikely that we're going to see a rate hike in 2024. But of course, nobody really knows what's going to happen remainder of 2024. So in this video, I'm going to break down, of course, the markets here, how they reacted. I'll break down some of the comments from Jerome Powell. And I will be doing a more dedicated video of the summary of FOMC and kind of like my take and my thoughts on this entire event. As always, if you enjoy this video and find it helpful, make sure that you drop a like and don't forget to subscribe to the channel if you're just joining us for the first time. And links to our Discord and Patreon is going to be down below. If you want to join and get access to all the members-only private videos, I will be posting more in the month of May with some trade ideas as well, with some options alerts and trade alerts. Everything's going to be included. The first week of the month is the best time to join, so I'd love to have you on board. This right here was the reversal. So we did see, again, a reasonable rally here after the statement and during the press conference, only for us to see that rotate back lower and sell back down. We're pretty much NASDAQ down about 33 basis points and S&P also down 33 basis points, with the Dow Jones pushing higher a little bit. So a little bit of rotation out of tech over to some of the more staple, more defensive stocks. So this right here was not the V-shaped recovery that we were looking for, but really just an A-shape downtrend, or basically selling right back down. So a little bit of a rug pull from Wall Street as they kind of digested what exactly happened here. Now, this right here again was the market. So there were some stocks obviously pushing higher in big tech, with the likes of Microsoft. We did have Meta pushing up 2%, Amazon after the earnings up 2%, Google was up 0.5%, Apple selling off, Tesla also down 1.7%, and the entire semiconductor sector struggling, with Nvidia down about 3.8%, AMD down almost 9% after the earnings. A video coming out on AMD very soon, along with Applied Materials, Micron, Broadcom, all these companies obviously selling off here on the day. So this was the entire market. Small pockets within the big tech pushing higher, with energy sector down, semiconductors down, auto manufacturers also selling off, with industrials also pulling back here. So a little bit of a mixed day. With technology, of course, selling off, along with consumer defenses and industrials, and then utilities and comm services pushing higher. In the last 1 month, utilities is quite literally the only sector that's been pushing higher. Everything else is straight up down here in the last 1 month, and this right here is going to be the futures and the commodities. So orange juice, platinum prices pushing higher, with cocoa and volatility selling off, and Bitcoin now under 58,000, and Ether now well under $3,000 as well. So Dow closes higher as Powell says Fed's next move is unlikely to be a hike, and Powell pretty much rules out a hike as a central bank's next move. So the problem with this headline is that it kind of gives you this idea that, okay, at least the hikes are not on the table. At least Jerome Powell and the FOMC is not going to increase interest rates, but that cannot be further from the truth. How many times has the Federal Reserve told us one thing and they have done something completely different? How many times? How many times have they told us one thing and they have done completely different things? How many times? I want you guys to pause this video and answer this question in the comments. Every time. Every time they told us inflation was transitory, they said rates are not going higher. We're not even thinking about raising interest rates. We're not even thinking about, shrinking our balance sheet. Like, there's a lot of things that Jerome Powell and the FOMC has told us, and then the complete 180-degree switch to do something completely different, because it's all subject to market conditions. It's all subject to what happens in the economy. So Jerome Powell saying that the Fed's next move is unlikely to be a rate hike is quite literally valid for 10 seconds, because that was in that moment, during that time, at that point in time, his comments. What happens 10 seconds later? Nobody knows, right? So the idea is that, yes, this does seem a little bit more on the dovish side, that, oh, he's ruling out a rate hike. It's not the case. I'm not saying that rate cuts, if they're saying rate cuts, that they're going to happen also, right? Because it goes both ways, right? Just because he's ruling out a rate hike doesn't mean it's not on the table. And just because he's very much saying about rate cuts doesn't mean that it's on the table, right? It goes both ways, because whatever Jerome Powell and FOMC says is, again, very contingent, very subject to what happens in the economy and of course with respect to inflation. Powell says he wants a shrinking of balance sheet to be smooth. So there was a passive pivot, and passive pivot is essentially not the beginning of quantitative easing, but somewhat of an end of quantitative tightening. So I want you to be very clear in understanding this. I asked this question in our live stream, and what is easier and faster for the Federal Reserve to do? Is it quantitative easing or is it quantitative tightening? What is faster for the Federal Reserve to do? QE or QT? And almost everyone got that answer, got that question correct, and that was quantitative easing. Quantitative easing is faster and easier for the Federal Reserve because they can cut interest rates down to 0% in a heartbeat. They can start buying bonds and treasury securities in the tune of hundreds of billions of dollars each month in a heartbeat, right? They can start printing money in a heartbeat. So it's much easier for the Federal Reserve to push liquidity into the system than it is to take liquidity out of the systems, right? So quantitative tightening is slower. It is more challenging. It needs a lot of time versus quantitative easing, which is a lot easier, a lot faster, more quicker. So with that in mind, the Federal Reserve and Jerome Powell understands this very well, right? They understand this concept very well, and that's exactly why they don't want to quickly shift from quantitative tightening to quantitative easing just yet. They want to wait until the very last moment that it's absolutely necessary for them to pivot and shift policy from quantitative tightening to quantitative easing. Right now, what they're doing is that they just introduced a passive pivot starting June 1st because they're going to be reducing the cap of their treasury securities that are maturing each month from $65 to $25 billion. So the reduction of their balance sheet continues. They're still going to be reducing the size of the balance sheet, but the pace of that reduction is going to slow down further, right? So they're not going to be doing that as quickly as what we previously saw from the balance sheet shrinkage. Another thing is the mortgage-backed securities. They're going to continue at that $35 billion cap, I think it was. But anything that's excess of that $35 billion redemption is going to now be reinvested back into treasury securities. So that is actually a little bit of buying that the Federal Reserve is now starting to do. Because they're now going to be reinvesting capital back into treasury securities. So they're going to be buying, which is a little bit crazy to think about because they're on one hand they're letting these treasury securities mature at a lower cap, but at the same time they're actually now starting to go and reinvest some of that excess capital back into treasury securities. So they are somewhat starting a little bit of quantitative easing on that aspect of their balance sheet. So it really is an inflection point in the Federal Reserve as of yesterday when the meeting was happening and when Jerome Powell introduced this and the statement was released, that they are now introducing some type of a passive pivot and they're moving away from their super high interest rates and quantitative tightening. And this actually changes our analysis on the bond market as well, because this actually bodes well for TMF and TLT. The reason being is because any excess capital above their mortgage-backed security cap of $35 billion is getting reinvested into treasury securities. And that is demand, once again, coming back in. And the Federal Reserve is probably one of the biggest, demands, that biggest representative of demands in the treasury market. And if they start buying back in, that means more demand, means prices higher, yields lower, and that's what's going to keep the yields a little bit more stable and restrict the yields from going crazy in the free market. So that is probably one of the reasons why the markets rallied the way they did. But I think the markets are still trying to understand and digest the idea that we're still not in the clear yet. If inflation comes in hotter than expected, May 15th is when the inflation numbers come out. If we get other reports that are suggesting for even a stronger economy, unemployment numbers come out, this Friday. So there's a lot of things that the Powell and Jerome Powell, of course, Federal Reserve is going to be looking at to better understand whether it is even time to begin that type of quantitative easing or not, or whether it's time to increase interest rates a little bit more or keep them where they are. So there is a lot of uncertainties, but again, this was one of the first signals that we got from the Federal Reserve that there is some passive pivot happening with regards to their balance sheet. It is really to ensure that the process of shrinking the balance sheet down to where we want to get it to smooth one and doesn't wind up with financial market turmoil the way it did last time we did this and the only other time we've ever done this, he also said. And Powell also mentioned or ruled out the possibility that the next policy move at its June meeting will be an interest rate hike. I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. But just the idea that we're having this conversation tells you enough of how things have changed, right? Nobody in their right mind even thought going into 2024 that rate hike would be a conversation piece. But now asking this question and Jerome Powell having to answer this in itself is a signal that we're even thinking about a potential rate hike in June. So markets are already starting to prepare for this idea that, okay, it's unlikely, but it is a possibility. Until last year, end of last year, nobody even thought that it was a possibility. But now it is becoming a possibility, and it's a question that's being discussed. So, I think that's also very, very indicative of how things have shifted, how things have changed over the last 6 months because of more elevated and more stagnating inflation. Asked about what it would be, what it would have to take to rate increase, Powell said, I think we need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing at the moment. But they're also not getting any greater confidence that this is sufficiently restrictive to bring it down. So really what we're seeing is some stagnating inflation. So the policy that we are seeing today is just about okay to keep inflation where it is. It is not going higher. It is not going lower. It is kind of maintaining its level at around 2.83%. And, if you ask me, like in my personal opinion, I think there is a possibility for more rate hikes because if you do actually, let's say 25, 50 basis points more, then inflation comes down faster, right? Or really helps with this battle of bringing inflation down to 2%. And then you can always cut interest rates in the future, right? Because quantitative easing, like I said, is much faster, more quick than quantitative tightening. So that is something to keep in mind because at the end of the day, really the bigger battle is with inflation. It's not with recession or unemployment. The bigger battle is with inflation because dealing with inflation takes longer. It's more challenging than it is dealing with a recession or unemployment because again, we go back to this idea, this question, quantitative easing. What is easier and faster to do, quantitative easing or tightening? It's easy. It's quantitative easing, right? That's much better, much easier, much faster to do for the Federal Reserve. So if I were on the Fed, if I were Jerome Powell, I would be looking at potentially raising interest rates maybe one more time or a couple more times this year to really bring inflation down. And then, of course, start focusing on quantitative easing. But I think they've taken an approach to kind of wait and see, allow for greater confidence, but they're not even getting that this year. So that's what Jerome Powell mentioned, that so far this year, the data has not given us the greater confidence that we needed. It's likely that gaining such greater confidence will take longer than previously expected, and we are prepared to maintain the current target federal funds rate for as long as appropriate as well. So coming over to the markets here. So if you come take a look at the S&P 500, so what you will notice is a huge rejection at 15,900. So that's actually quite crazy that we actually got up to that level resistance that we pinpointed in one of our previous videos. And of course got rejected right away at that resistance and then rolling right back down. So next support really is going to be down at 15,200 to as much as 15,185. This is still within the context of a little bit of an uptrend, but of course there was a lot of volatility intraday. Maybe some support sitting right over here at 15,500 on the NASDAQ. And of course below that, we're going to be looking at 15,200 on the NASDAQ here. Talking about S&P 500, also getting rejected at this 5,080 to 5,100 level. Got up to that level, of course, reversal back down. Next support, there's going to be a couple support levels to watch. Number one, sitting at 5,000. Next one sitting at around 49.90, and then a much stronger, much better support sitting at 49.50 for the S&P. And resistance stays put at 5,080. So we really are still not cleared out of the woods yet, still trading within the context of a little bit of a downtrend. Although in the short term, I would still argue maybe there is some potential, but those support levels need to get validated and we need to start seeing some higher highs and higher lows once again in order for this reversal to take place. But until that happens, we are still nowhere near close to a reversal yet. So we're not out of the woods just yet. Talking about Apple here. So Apple stock consolidating sideways. Again, there's not really much for us to go over other than the fact that it's really just trading in this green rectangle, which has been a very, very strong area of support, and a much better area of demand is going to be in the 150s down to as low as 130s for Apple. So those right there are going to be a couple levels to watch. Resistance all the way up to 195, 196 for Apple moving forward. Talking about Amazon. So Amazon here also consolidating sideways. Resistance is going to stay put at 188. Support level down as low as 171, down to as low as 158. So really, I've got my entire shopping list ready. If the markets continue to slide lower and sell off, that's actually good news because as we have discussed, prices coming down is buying opportunities. It's discounts for us for us to take advantage of those deals. So 171 down to 159. Next few support levels to keep in mind. Tesla, on the other hand, also selling off 1.8%. So back under 180. Support level is going to stay put at 177. This is exactly why I sold the covered calls on Tesla, because I did, I believed that there was a huge supply and resistance in the 200s that Tesla is going to struggle to break out of, and those calls of course are up now over 80%. So if you want to get access to all the alerts and find out exactly what I'm buying, what I'm selling, link's going to be down below for you to join our MoneyVest community. So support level, like I said, down to 177 with a very strong area of demand in the 150s for Tesla. Nvidia, on the other hand, here just pushing down at 3.89%. And this one right here, we'll go ahead and turn this level back into a resistance, back support at 741. That's going to be the level to keep in mind. We're still, I would say, making lower highs here and lower lows as well. So Nvidia is still very much, I would say, in the context of a bit of a downtrend. So not really seeing a lot of momentum back higher, but really there are some sellers present that are pushing the price down. We did drop over 22% and recovered a little bit back higher, but next support really is going to be down at 744. Advanced micro devices with a huge sell-off, and this resistance acting perfectly as a rejection point at 150. Support level is going to stay put down at 130 for AMD. That is going to be that next target, and of course with a very strong momentum lower, downtrending channel 37% lower. Next support down at 130s. I'm looking at cash secured puts on advanced micro devices moving forward as well. PayPal getting rejected after the earnings. I've got a video coming out on PayPal very soon. Huge resistance and supply area at 68 to as much as $70. Support level is going to stay put at 65. So this right here is going to be that level, all the way down to $57, $58 per share for PayPal moving forward. So huge resistance, huge supply here at 68 to $70 for PayPal. Talking about Visa, and Visa here also continues to slide lower, coming down to our support at 265. Again, Visa is also part of our shopping list with my nibble price, light buy, aggressive buy, all that stuff is going to be included. And again, we've got the oversold RSI MACD and the price itself coming down from its all-time highs, down a little bit over 8% now. So 250 down to 234, some of the other really, really attractive levels to keep in mind for Visa. Talking about Meta platforms, and Meta here, consolidating sideways after the earnings. Huge resistance and supply here, 455 to as much as 476 for Meta, and support level very strongly sitting at 385 for this company here. Talking about Netflix, and Netflix also consolidating sideways, very similar to Meta, not really going anywhere, but that support level is going to stay put at 536. Resistance all the way up to $597 to $600 per share for this company. Google, on the other hand, just obviously gapped up after the earnings, selling off a little bit here. Support level is going to stay put down to 161 to as low as 152. We had a very nice trade idea on Google. But that support level is going to stay put at 154 for Google moving forward. And then finally, talking about Microsoft, and Microsoft here also just selling off a little bit from its all-time highs. It is down about 8%. So coming down to that correction territory, RSI MACD also selling off. So there will be opportunities for Microsoft as well. In my opinion, next support is going to stay put down to 364 for this company. So that is going to be that level to keep in mind for Microsoft, all the way down to 349, 350s for this business. And then finally, we come over to Enphase and Costco. Enphase here also breaking down a little bit over 3%. Next support and target is going to stay put at $90 to $93, and a resistance all the way up to 138. So lower highs and lower lows, so continues in this downtrend. Next support, like I said, $91, $92 per share for Enphase. And then finally, we come over to Costco. And Costco here, lots of consolidation sideways. Resistance is going to stay put roughly at $745, down to $704 per share. And again, just a lot of consolidation here in this range for Costco. So hope you all enjoyed this video, and a quick update on the technicals on individual stocks, not to mention the overall market and the Federal Reserve's policy as well. We'll be catching up on a lot of earnings videos for these companies. So I've got a video coming out on PayPal, Enphase, Meta Platforms, Advanced Micro Devices. I know you guys have been waiting for it for a long time, so I do promise I will deliver over the next 3 to 4 days. But stay patient. I really appreciate you guys. As always, make sure that you drop a like, subscribe to the channel, and again, links to our Discord and Patreon is going to be down below if you want to join. Of course, be a part of our MoneyVest community. As always, happy investing. I'll see you all in the next video.